Okay, so you're ready to sort out these investment options.
Index funds.
Mutual funds.
And ETFs.
Yeah, it can be a lot.
It sure can.
Well, you've got your research right here, and that's where we come in.
We're here to help you figure out the most important stuff.
And which option could be your best fit.
It's pretty interesting how these three are all related, but they've got some really important differences.
Okay.
To picture it, think of mutual funds like those pre-made gift baskets.
Oh, okay.
You buy one basket, and instantly you've got a lot of different companies.
Oh, I get it. So you're not putting all your eggs in one basket.
Right, exactly. That's the whole point of diversification.
Spreading out the risk.
Right. Now think of a mutual fund,
Okay.
but it's basically on autopilot. That's an index fund.
So instead of someone picking stocks.
Yeah, it just follows a specific market index,
Right,
like
yeah.
the S&P 500.
Ah, so it's like a robot chef.
Yeah.
That's programmed to make the same dish perfectly every time.
That's a great way to think about it.
I like that analogy.
Then you've got ETFs.
Which are?
They're kind of like index funds, but with a little twist.
Okay.
They track an index, but they can be traded throughout the day on the stock market.
Just like individual stocks.
Exactly.
Oh, so are they riskier then?
That's a good question.
Because it's...
You might be tempted to trade them all the time.
Yeah.
We'll definitely get into the potential downsides of that later.
Okay.
But first,
Yeah.
did you know that mutual funds have been around way longer than most people realize?
Really?
We're talking the 1800s.
Wow, the 1800s. That's
They
crazy.
seem so modern.
I know, right? What was the point of them back then?
Well, imagine trying to buy 100 different stocks on your own.
That sounds like a nightmare.
Yeah, a real headache.
Yeah.
Mutual funds were first made to make investing,
Easier.
accessible to everyday people.
Ah, so everyone...
Roll their money together,
And then...
buy a diverse collection of stocks without all the hassle of managing each one.
Yeah.
It was like a group effort.
So everyone got together and said...
Let's hire a pro to manage our money.
Exactly.
And that pro is called a fund manager.
Okay.
They're the ones who choose the specific stocks that go into the mutual fund.
So they're supposed to be the experts.
Right.
Who pick the stocks that'll make the most money.
Exactly.
That sounds pretty good.
Yeah, but
There's got to be a catch.
you're catching on.
Nothing's ever that simple.
You got it.
So what's the catch?
Those fund managers,
Yeah.
they don't work for free.
Of course not.
They charge fees.
Okay.
And those fees can cut into your profits over time.
Like how much are we talking?
1 to 2% of your account balance.
Annually.
Yeah.
Yikes. That could add up.
It really does.
So even if they don't pick good stocks, they still get paid.
That's right, regardless of whether the fund makes money or...
Or loses money.
Right.
Yeah.
Which brings us to a really interesting story.
About a guy named Jack Bogle.
Jack Bogle.
He got so frustrated by the high fees that mutual funds charged that
That he what?
he decided to,
Change things.
yeah, revolutionize the investing world.
Whoa. Okay. Tell me more about this revolution.
Well, Jack believed that instead of trying to beat the market,
Which is hard.
really hard to do consistently,
Yeah.
he thought investors would be better off just matching the market's returns.
Okay.
And that's how the index fund was born.
So it's like,
Like what?
instead of trying to invent some fancy new dish,
Okay.
you just use a recipe that's guaranteed to be delicious.
Another great analogy.
Thanks.
And the best part is this recipe is super low cost.
Oh, why is that?
Index funds are passively managed.
Which means?
No expensive fund managers.
Ah, I see.
Your research actually mentioned the Vanguard S&P 500 Index Fund,
Okay.
which only charges a fee of 0.04%.
Seriously?
Yep.
That's way less than 1 to 2%.
Right. Huge difference. Wow, that Jack Bogle was really onto something.
He was.
Okay, so we've got mutual funds, which offer convenience and diversification, but can come with those high fees.
Right.
And then we have index funds, which are low cost, track the market, and basically run on autopilot.
Yep.
But we haven't really talked about ETFs.
Right. And those are really interesting because
Because...
while they're like index funds,
Okay.
in that they track a specific index,
Right.
they also, they
Yeah.
trade throughout the day on the stock market, just like individual stocks,
So you could buy or sell.
at any time during the trading day.
But doesn't that make them riskier?
It's a good point, and a common one.
It seems like.
You might be tempted to constantly time the market.
Exactly.
And actually,
Yeah.
our source actually prefers index funds over ETFs for that very reason.
Really?
They think that ETFs' ease of trading can lead to,
Bad decisions.
impulsive decisions based on what the market is doing right now.
Ah, okay.
And that can increase risk.
It's like having a plate of cookies in front of you all the time.
Mm,
It takes a lot of willpower to resist.
that's a great way to put it.
I love cookies.
Our source specifically mentioned
Mentioned what?
this thing called automatic reinvestment.
Okay.
It's a feature of index funds that
Yeah.
they love.
Okay, what is automatic reinvestment?
It's really great for long-term growth.
How so?
Well, any dividends that your index fund earns get used to buy more shares of that fund,
Oh, so you're essentially
compounding your returns over time
automatically.
without you having to lift a finger.
So it's like a snowball rolling down a hill.
And getting bigger and bigger.
You got it.
I love that analogy.
It makes it so much easier to understand.
It really does.
So it sounds like our source is a fan of that set it and forget it approach.
Yeah, definitely.
But before you decide if that's right for you,
Right.
we need to figure out which of these options,
Overall.
yeah, overall might make the most sense for your specific goals. All right, sounds like a good place to pick back up next time.
Absolutely. Okay, welcome back. So we talked about mutual funds, index funds, ETFs.
Right, and now it's time to figure out,
How to find the one that's right for you.
yeah, because my head's spinning a little bit.
I bet. It's a lot to take in.
It really is.
But let's break it down.
Okay.
So first things first.
Yeah.
What's your investing style like?
Ooh, good question.
Are you hands-on or more hands-off?
Well, I know some people
Yeah?
love researching companies and picking individual stocks.
Right.
But honestly, that sounds exhausting.
It definitely can be.
I think I'm more.
Hands-off.
Yeah.
That's actually super common.
Really?
Yeah, especially when you're first getting started.
Okay.
And you know what? If
Sure.
that set it and forget it style appeals to you,
Yeah.
index funds could be a great option.
Okay.
You just choose a fund that matches your goals and how much risk you're okay with.
Right.
Set up those automatic investments and...
And just let it do its thing. Okay, that definitely sounds more my style.
Good.
But what about ETFs?
Oh, yeah, ETFs.
Where they fit into all of this?
Well, they're really interesting because
Because,
they offer a lot of flexibility.
in what way?
Well, remember, they trade like stocks.
Yeah,
So you can buy and sell them all day long.
which appeals to.
More active investors who want to try out different strategies.
Or people who want to react quickly to the market.
Exactly. But remember,
The cookies.
yeah, that plate of cookies.
I do, and I don't want to resist.
That ease of trading can be tricky.
How so?
It can tempt you to make impulsive decisions,
Based on-
whatever the market's doing right this second.
And that can be risky.
Very risky.
It's kind of like
What?
easy come, easy go.
Yeah.
If you make a quick profit,
You might think,
I can do that again.
yeah, and then whoops,
You lose everything.
it happens.
So knowing how much risk you're comfortable with is so important.
It is. It's not just about how much money you could lose.
Yeah.
How do you handle it when things go up and down?
Emotionally.
Exactly.
Oh, okay.
So someone who doesn't like a lot of risk
Right.
might be better off with an index fund.
That just steadily tracks the market
Right. And someone who's okay with risk
and likes the excitement.
might be drawn to ETFs.
Makes sense.
All boils down to
Sure.
you, your personality and how comfortable you are with risk.
Okay. And we also can't forget about,
Goals.
investment goals.
Those are really important.
They are, because it's different if you're saving for a down payment on a house
Right.
versus saving for retirement.
Huge difference.
Yeah, like 30 years from now.
Exactly. And your research talks about this.
It does.
For long-term goals, retirement.
Yeah.
Index funds are often the top recommendation.
Right.
They're low cost, diversified, and they're made for steady growth.
Over a long period of time.
Yeah, so if you're not retiring anytime soon,
An index fund can just be working in the background,
exactly. But for shorter term goals,
like saving for a house or a big purchase.
yeah, things get a little trickier.
You don't want to put all your money in the stock market.
If you're going to need it soon,
Right, exactly.
it might be good to,
You diversify.
yeah, maybe add some bonds or other assets that aren't as volatile.
Oh.
But exploring that is for another deep dive.
Another time.
Yeah.
All right, just to recap,
Okay.
mutual funds are convenient and offer diversification.
Right.
But the fees can be a problem.
Yep.
Index funds are low cost
And perfect for that hands-off approach.
and for long-term goals.
Exactly.
And ETFs are flexible,
Which can be good and bad.
depending on you.
Yeah, your personality and how you use them.
I like it.
Good summary.
Thanks.
Remember, there's no perfect answer for everyone.
Right.
The best choice depends on your needs
Your goal.
and how much risk you're okay with.
What works for one person might not work for another.
Exactly. It's easy to get caught up in what everyone else is doing.
Yeah, or the latest hot investment.
but it all comes down to you and your situation.
I agree. So true.
And speaking of things that people often overlook,
Oh,
there's another really crucial aspect of investing.
what is it?
It's not really talked about in your research,
Hmm.
but it can have a huge impact on your success.
Okay, I'm intrigued.
It's the psychological side of investing,
Oh, interesting.
the mental game.
The mental game of investing.
Yeah. We tend to think of investing as this logical numbers thing
Right. Our emotions get in the way.
all the time, whether we realize it or not.
Well, we're human,
Exactly.
not robots.
Right.
And when it comes to money, especially our savings.
Things can get intense, and those emotions, especially fear and greed,
Yeah.
they can lead to some bad decisions.
Like what?
Like selling everything when the market drops,
Oh, yeah.
or chasing some hot stock tip you heard about.
Without doing any research.
Exactly.
Oof. So how do we avoid those traps?
Good question.
How do we stay calm when everyone else is freaking out?
Well, first you have to be aware
Yeah.
that those emotional biases exist
Okay.
and that we're all susceptible to them.
Oh, no.
It's not a weakness, it's just part of being human.
So step one is admitting
Admitting what?
that we're not always rational.
Especially about money.
True.
Uh,
But what do we do with that awareness?
that's where a solid plan comes in.
Okay.
Think of it like a roadmap for your journey.
Oh, okay.
When you have a plan
Yeah.
with your goals and risk tolerance all laid out,
You're less likely to...
make impulsive decisions.
Got it. So even when things get crazy,
You've got those rules to follow.
like an anchor.
Exactly. It keeps you grounded and focused.
Yeah.
Prevents you from getting swept away.
By all the chaos.
You got it.
Makes sense. But what about when the market tanks and
And
you see all your money disappearing?
That's when the panic really sets in.
Exactly.
And that's where diversification is so helpful.
Right. Spreading your investments out.
Across different assets and sectors and regions.
It's not just about managing risk.
No, it's about managing your emotions too.
So even if one part of your portfolio is doing badly,
Another part might be doing okay.
right, and that can help prevent,
Those fear-based decisions.
like, the safety net.
Exactly. You know that even if one investment stumbles,
The others will cushion the fall.
right, helps you stay calmer.
Oh, I'm seeing how it all fits together.
Yeah.
Having a plan, diversification,
It'll help.
to feel more in control,
Absolutely.
even when the market's going crazy.
You got it, and there's one more ingredient.
Oh, what's that?
Patience.
Patience. Ugh, that's a tough one,
I know.
especially these days.
Everything moves so fast.
Exactly.
But investing is a long game.
Okay.
It's not about getting rich quick.
So it's more like a
Marathon.
than a sprint,
You have to pace yourself.
and trust the process.
Or not get discouraged.
Even when there are setbacks,
The market's always going to go up and down.
it will.
So we shouldn't panic and sell when it dips.
Exactly, because historically, the market goes up over time.
Right. Just try to resist that urge to react emotionally.
Yes.
Stick to your plan and let time do the work.
Okay, it sounds like we're going to have to learn how to master...
The mental game of investing.
Yes. That's what I need.
Well, that's a perfect topic for our final part.
All right, can't wait to hear it. Okay, so we're back and ready to tackle this whole mental game of investing thing.
You know, it's funny.
Right.
We often think of investing as this super logical thing, all about numbers.
Right.
But emotions play a big role,
Oh, they totally do.
whether we realize it or not.
Well, yeah, because...
Human,
Exactly.
not robots.
And when it comes to our money,
Our hard-earned savings.
it can get really emotional.
For sure.
And those emotions, fear and greed,
Yeah.
they can lead us to make some decisions.
That we regret later.
Exactly, like selling everything when the market drops.
Oh, been there.
Or chasing some hot stock tip
That you heard from who knows where.
without doing any research. Yeah, okay, so how do we avoid those traps?
How do we stay level-headed when everyone else is losing it?
Right.